Daily Fiscal Pulse for the 8th of June, 2026. We're covering Monday's trading session. Everything you're hearing is final data, so take it at face value as we move through the breakdown. Let's start with what's driving market attention right now. Artificial intelligence and technology stocks are dominating the conversation. You've got Anthropic releasing what amounts to a mythos-like AI model to the public, just 2 months after their private rollout created significant waves. That narrative is clearly influencing trading patterns today. Of course, market themes can pivot quickly, but the actual flows tend to be more reflective of reality. Looking at the fiscal numbers, the net transfer came in at $18.2 billion. That standing alone looks reasonable. What's more telling though is the directional shift. We're seeing the 5-day flow drop to roughly half of recent levels. Tax receipts are shouldering the bulk of this, coming in at $32.8 billion. The market is reflecting that dynamic. E-mini S&P futures wrapped at 7,416, which puts us substantially below the 20-day moving average of 7,506. The broader 20-day trading band spans 278 points and continues to drift downward, so the fiscal data and price action are aligned in their message. Zooming out, the 5-day average for government spending sits around $4.7 billion daily. Set that against the 20-day average hovering near $14.5 billion, and you've got a clear deceleration. Less money is flowing through the system, which means less cash reaching households and filtering into asset prices. That's tightening financial conditions in real time. The year-over-year picture reinforces this. Spending is essentially flat at $1,104.9 billion. There's no material change in fiscal support to work with. From a market positioning angle, this fiscal setup isn't tilting the odds in either direction. Our conditions gauge reads -18. History tells us something interesting though. We've encountered this dynamic repeatedly, and even when liquidity softens, the S&P has managed roughly plus 1.6% returns over the following month on average. Prices don't always dance in lockstep with cash flow. Sometimes they just grind ahead anyway. That said, the current positioning warrants attention. Leveraged funds are trimming positions while margin debt sits at the 100th percentile. Those elevated levels have historically functioned more as caution flags than buy signals. How does this translate to market behavior? When fiscal flows trail year-ago levels, the financial system has less cushion underneath it. Rally-friendly news can still push prices higher, but when shocks arrive, say a flare-up in AI/tech volatility, declines can accelerate because there's simply less liquidity buffering the fall. 3 straight days of declining fiscal transfers have emerged. That pattern typically shows up in price action with a short delay. What might shift the picture? The 10th of June brings the SSA payment cycle, second Wednesday of the month, which has the potential to reshape near-term cash flows. Fiscal headwinds are definitely visible in today's data. The rate at which conditions are tightening may be leveling off though. The next catalyst probably hinges on how these scheduled transfers settle. That's where we stand heading into the next trading day.